Hey, if you're like me, you're probably bombarded with a lot of people telling you what to do with your money. People you know, people you don't know. I think there's sometimes it works, but most often it doesn't. In this video, you're going to learn a proven wealth strategy that has worked for countless individuals. And the reason why I say that is because this video is for clients of my firm. It's a live stream event that we do every single month. And currently we represent about 8,000 households nationwide. So you're going to get kind of an inside view of a particular wealth strategy, how most people approach it, and a different way to approach it. So I can't wait to hear your feedback. So make sure you like the video if you do, and subscribe to the channel. We'd love to hear your comments as well. All right, on to the video. Okay, let's get into some calculators. So we're gonna first talk about this little chart. So this is a company called Dalbar, and they actually came out with their full report. They do a report every year. They've done it for decades. And what it does is it measures, obviously, the standard market indexes. You can see here, the S&P 500. But they went in and actually are studying just the average equity investor returns, fixed income, which is another word for bond, and essentially the combination of those two funds, which is the modern portfolio theory, which, as you can see, 30-year average, it's incredibly low, 3.5%. Then you factor in inflation.
So we're looking at the middle column that's average
right.
asset allocation fund investor, and that 3.53 number for 30 years, 3.72 number. And again, as Patrick's indicated, the full report is available for you to look at. But I just want to drive this home. On the left-hand side is the average equity fund investor. And let's just pretend you're looking at your one account that happens to be all stocks and you're not thinking about any of your other accounts. Yep. Average return, 10%, 9.18%, going down the list, 9.78%. Average investment return.
Yeah, not what the stock market did or not what the S&P did, but the actual results of what the investors did, which is a big difference.
Well,
right?
But what the investments did. The middle column, correct me if I'm
Well, that's
inaccurate.
a combination with the bonds.
Okay, understood. And it's the investors' returns. Mm-hmm. So we don't really have a column with the first two.
Yeah, so Dalbar, the approach they take is there's all sorts of contributing factors, right, to why is the return so low, right, the 3.53.
Yeah.
And there's the contributing factor of human behavior. That's why behavioral finance, behavioral economics exists, right? Because when things start to happen in money, people think they're making a rational decision, but ultimately it's an emotional decision. And it's the reason why people, buy high and sell low, right? Which is supposed to be the other way around. But it's also because of this kind of mix of assets. When you look at the bond market and bond returns, you look at the equity markets, and when you combine them, according to modern portfolio theory, what assumably would be non-correlation has become correlation, right? So even though they're totally two different securities, how they move and the returns that they get, right, it's on the same vein. And so that's why I wanted Todd built a really cool calculator, I think last year, or added some elements to an already cool calculator, but added some elements in there that demonstrate this. Yeah. So let's cut to the.
Oh, we want to look at that now?
Yeah. Oh, yeah.
Okay.
Sorry, we're not prepared to run your calculator.
Oh, he's prepared.
Oh,
he's
nice.
Always prepared. So if we could have my computer on the screen, that would be wonderful.
Oh, cool.
Beautiful.
So if we look at this, and we can look at the history, and so if we just go back 25 years, because that's kind of what we're going to be talking about in a little while.
With our scenarios, yep.
Later on. And even using like the S&P without dividends, so a composite stock index,
yep.
Right? We can see that, by itself, it's 7.33 over the last 25 years.
With dividends, it's 9.29. But that's when fund managers are measured, their benchmark isn't the S&P with dividends.
Right.
Their benchmark is the S&P composite, right, which is without dividends.
And then looking at a combination with a 70-30 split. So if we add in that certainty aspect, supposed to be an uncorrelated asset, right? That's where it started. Yep. Now they're finding out it's actually more correlated than what was originally planned, yep. The basis of modern portfolio theory, right? Yep. And so what we see is with the Dow Jones Composite doing 30% in that, where it has currently done 5.62. The two together, what we're looking at is an average of 6.82. Now, that's not the actual return, right, which can be drastically different because of those ups and downs. They don't actually come out as an average when we look at what the actual dollars are, which
let's show that. So basically you're saying if you put a lump sum of money into this and experience this return, the return is going to be different than if you consistently put money in. Like there's this term dollar cost averaging that you've probably heard about, right? Which is conditioning people, helping them save, not necessarily annually lump sum, but over the course of time, typically monthly.
Right, and the idea makes sense, right? The idea behind it is, okay, you have a down year and you've put money in, but when you're up year, if you've gone ahead and put money in, you get to experience that side of it, and it's supposed to overtake those down years. And so over time, the idea is if you are consistent, you'll consistently get that long-term growth, right? But what we see here is, so if we put in just a lump sum on the present value, Kim, just put $1,000 in there on present value. Yeah. And so what we see is over on the far right, where our combination is, our blend between the Dow Jones Composite and the S&P, right? We see that rather than the average of 6.82, we actually end up with 5.95. Now, this is before any fees or taxes or anything else, right? And so the reduction there, it doesn't look like it's a lot, right? It's about a point.
Yep. A little less than a point.
But what happens over time is it's much bigger than that. Do we want to look at that just briefly? Yeah. Why don't you grab a couple of future value calculators and let's just take a quick look at what the difference between those two numbers is. So we'll use our same $1,000 present value. Or let's make it 100,000. Is that what you have there? Mm-hmm. Yeah. Okay. And let's put in 6.82.
Oh, that's $1 million.
Yeah.
That works.
Doesn't matter. Dollar amount doesn't matter.
All right. And for the time frame, let's put in our 25 years. And we see that would grow to $5.2 million. Mm-hmm. But now then let's take the same $1 million over the same time frame of 25 years, but grow it at 5.95 instead. And we see that there's $1 million difference. I mean, it's a drastic difference. Even though we can look at that and say, well, it's only a point difference. It actually has a long-term pretty large.
So that's about 20% impact.
Right. Yep. Okay, so.
And that's the nature of compounding, right? It's like you have huge gains in the latter years.
Yeah, they're not seeing the future value calculator.
Thanks
Thank
for the
you,
heads
Noah.
up.
Thanks, Noah. Oh yeah, they're not seeing it. Okay, well, so basically these two calculators. One of them is showing, essentially we're using that. Those average returns. It's not even showing the six. So on the 6.82, when you see that up in the right-hand corner.
Hang on.
Oh, there we go. Okay, now it's up.
All right. So now we see our
5.95.
Based on our 1 point differential. It actually has a 20% impact on the amount of money. What do we mean by that? Well, we went from 5.2 million to 4.2 million. So we lost about 20% of what the difference is, even though it's only a 1% differential between the actual and the average, which the average is what we hear about in the marketplace, right? Everybody quotes what the average is over the last 30 years or whatever, and that's simply adding all those returns up, positive, negatives, and dividing it by the time period. And it really does not directly correlate to what happens.
Yeah, so now going back to we won't go back to Dalbar, but that Dalbar report, it showed, I think it was 3.82, which was the average kind of actual the return of the balance, the balanced investor. And it always bugged me. I'm like, why is it so low? So obviously this is an indication of one of the reasons it's so low. Then you add in the behavioral side of things, and that kind of adds to why returns are so low. And people are essentially just getting ahead by the money that they're contributing, not by the returns that they're getting from the market.
Yeah, and one of the other problems that drives that too, on that differential, if we've got, I don't know what percentage of the people are retired, but if they're pulling money from the market, the problem is in those down years, they don't get to experience. If they have to pull it to eat and live off of, then they don't get to experience the upside, which we'll talk about more.
Well, just to finish it out, go to annual payment and just do an annual payment as opposed to a lump sum. Yeah, you guys can see the difference.
Do you want to do taxes while we're here at some point?
Yeah, we'll do that quick. So now you have an actual higher return.
That's interesting. And depending on what the time frame is in the market, that's is something that can happen.
Yeah.
And so here, dollar cost averaging actually worked, right?
It does. Yep. Now, one of the things is obviously we went through this food chain, right? So obviously there are several parties that are making all of this possible that are going to be charging fees. And so we actually, in the workbook, we put a link to a fee report that we did that goes back several decades, and it really looks at kind of a bell curve of some of the maximum fees that are out there with regards to 401ks and mutual funds, then also sort of the lower side, and then there's a median that we use as far as the fees we're going to present in our cases in a few moments. But the idea here is just as much as the information can help you understand what stocks you own, what funds you own, what their performance is. You can also look at the fee structure. A lot of that information is often hidden. You have to search for it, at least you had to do in the past. But a lot of the more modern information tools, artificial intelligence tools, allows you to find that information more readily. Okay, let's just throw in, maybe we'll throw in just a 1% fee as well as some long-term capital gains tax and just see kind of what the net returns shake out to be. So management fee 1.2, then let's look at maybe taxes at just do 15%.
Maybe 15 over there and more like 28 on the bonds.
Oh yeah, that's right, because those are taxed at income. Yep. So now you have much less of a. Then you add inflation into it, so you start to see that. Again, we're going back to the fund side of things, right? The multi-trillion-dollar industry is putting these funds together, and on the surface, it feels like there's money's going up. You're invested, you're saving, and you should be earning the market average, what displays on every morning TV show. But this is what people end up experiencing. Yeah. Okay. All right. Thanks for going through.
Yep.
That calculator, Todd, this is going to come up handy. We'll probably reference this in a little bit. All right, can we get the PowerPoint back up, fellas? So let's go to essentially the scenarios that we had found on these popular blogs. And there are a lot out there, and maybe it's just because I'm subscribed to everything. But really people are asking questions. This is my scenario. These are my numbers. This is the situation I'm in. What do I do?
And this is kind of a common one right here.
Yeah. This is,
right.
Yeah. So this is the actual quote from the article, and it is the basis of the advice that was given in that article. So I'm 70 years old, retired with a $2.5 million investment portfolio. I no longer need life insurance and am tired of paying the monthly premium for nothing. What are my options? Okay, and we sometimes get that. You guys may have asked that question as well. Oftentimes when you purchase a financial product, it meets a set of circumstances, benefits, needs of your present situation. But as your situation grows over the course of time, you don't have those needs anymore. And so why have it? And go ahead.
Well, I was just going to say, I think it's because we don't often understand the full picture of what that allows us to do, which is part of what we're going into. But if you think about it, I mean, for most people, like if I had a car and I'm paying insurance on it and I get rid of cars and I decide I'm going to start taking the bus or whatever else, why would I keep paying insurance, right? And that's what goes through people's mind, because oftentimes they're not shown how that impacts the rest of their ability to spend money and enjoy life, right?
The rationale is very surface level, not necessarily being able to run simulations. And when a financial advisor runs simulations, right, they typically will go in a certain direction that, on the surface may make sense to them, but it typically uses market averages to show them what they can potentially earn, whereas once what they put them into actually earns them much less.
Yeah.
So, okay, so this is here's the financial situation of this couple. So 70 years old and 68, so husband 70, wife 68. Their life expectancy. So there's an interesting article that Kim and I subscribe to this really cool newsletter called NFX. It's called Network Effects, and it's kind of the pioneer behind blockchain and that whole realm. And they sent something out this week talking about longevity, and their math and models are showing them that life expectancy could be, for those that are being born today, 160 years old. So right now, life expectancy is actually still in the mid to late 80s. And so we're going to factor in just a few more years given the incredible technology and how that curve is materializing. So we put 95 and 96 in there. And then the duration of how long they need income is 25 years. As referenced, $2.5 million. Their life insurance facts, death benefit, $2.5 million. Cash value is $1.6 million. And their home is worth $1 million. Their portfolio allocation is actually somewhat conservative, which we do see that, right, with portfolios set up for those that are in retirement. And then management fees, 1.09. So we actually did a full study on this specific scenario, and that's accessible in the workbook. And then the distribution strategy is what you may have heard of in the past, which is the 4% rule, which is based on some simulations and a lot of historical studies of what percentage of your portfolio you can take every single year without running out of money.
Yeah, which used to be 5%, right? It was 5% for a long, long time, up until about probably 15, 20 years ago, right?
Well, that's when the correlation, right, started between bonds and equities. So this is the typical financial approach. So step one, cancel the life insurance, right? Surrender the life insurance. Now you're going to pay taxes above basis. So what does that mean?
Well,
because life insurance is often seen as a tax favorable vehicle, but if you surrender it, cancel the policy, you could be in a tax situation.
Right. And you avoid tax altogether if you die with the policy, right? But if your gains are taxed, but you still get the advantage of the tax deferral on the growth that happens inside of the policy. But if you surrender the policy, then the amount you've put in premiums comes off the tax bill and you're taxed on the remainder. So in our example, if when they surrender, they're going to have to pay some tax on that gain.
Yep.
And in fact, here's what it is. Yeah. So it was $1,659,000, and they're going to have to pay some tax of about $500,000, which leaves them with $1,160,000.
Yep. So the next is, as you add this sum of money to the portfolio, now you have a higher income amount because obviously the portfolio is bigger. So that income amount is $146,400. Now, the Monte Carlo simulation, these withdrawal rates, they factor in an annual increase. We live in a monetary system where inflation is inevitable. It's borderline guaranteed, right? So this does factor in annual increases to their income. So here's the results. So they start off with the $2.5 million plus the life insurance, cash value, and they start taking this $146,400. At the end of the 25th year, the income is supposed to be $297,601 because of inflation, but they run out of money in year 20, right? And it's right in line. Like, we ran the simulations. It's right in line with what Monte Carlo says.
It is. And the thing about it is this $297,000, it may be really hard for a lot of people to get their head around this, because it's like in 25 years, it's going to take twice as much money, but we haven't gained any ground. And that's if inflation stays, down
3%.
in the 3% range. That's pretty low. But we see it all the time with people in retirement, because they don't have a source of, when they were working, they automatically kind of get cost of living adjustments along the way, and people really don't see the impact of inflation. They can look back and say, oh, man, I remember this is awfully expensive. I remember, 10, 15 years ago, it was only X. But they've had that increase in income to be able to compensate for it.
Yep.
When you get into that distribution phase,
you don't have that anymore.
You don't have that anymore. You don't have it to lean on. It's got to come out of those assets, and now it becomes more critical. And you see it all the time with people during that phase. If they didn't plan for that, then now they're starting to cut way back on lifestyle.
Yep.
I want to drive that point home a little bit, because my grandmother, the same one that we talked about with the MFS funds, in her late 90s or her mid 90s, her portfolio was reducing. Now, she had Social Security, and I don't think there was any pension. There might have been a little bit. And, here she is, blind, but still healthy. And we're watching her portfolio go down at about $4,000 a month, because she had a full-time care person living with her. And, mid 90s, right? You'd think, oh my gosh, there's probably not a lot of years left, and for her there wasn't. And so there was a little bit of leftover money from that portfolio. But think about, I'm so glad she couldn't see that. Think about the feeling of that going on. You are in your late 80s at the 20-year mark, right? Is zero. And in your late 80s, you're still healthy, ideally. My dad's in his late 80s, still working 3 days a week. And you're seeing your portfolio going down and down, and it's going down fast at that point. What is the cost of that happening that is potentially unaddressed in so much typical financial planning? Yep. And that's what we're going to look at.
So years of income, 20, the total amount of income, right? So starting with 3.6, taking all of those withdrawals, $3.9 million, right? Now, when you go 20 times 146, 400, that's not 3.933, right? It adds up all the increases every single year.
Yep.
All right, and then finally, what typically happens in this situation, obviously you have, Social Security, but we're really just trying to boil it down to some simple advice. The only option, unless they have, family or come into other money, is to take a reverse mortgage on the house or sell the house, and ultimately that becomes the legacy or what's left over. So let's go into the actual graph that shows this when we did our model. Let's talk about kind of the volatility, right? Because I think that's really important to understand. Because you had mentioned it, obviously when you're growing money, the averages work in a certain way. But when you're withdrawing money, and this is why the Monte Carlo simulation really exists, is you face a different set of circumstances when it comes to the risk you're taking.
Right. Well, see, most fund managers will tell you that if they could dictate when money came out of the fund, they could drastically change the longevity of that fund, right? And it's because of you don't want to take money in a down year. And like you said, that was perfect, is during the accumulation, the averages are almost right. And the reason is you're in for the long haul, and if it goes down a little bit, the money's still there, and it's just a paper loss, right? And then it goes back up because it's following that curve, and all the money's there to take advantage, or all the stocks
and you're adding to it along the way.
That's
so
right.
It may just be going up because you're adding.
It could be, but you don't have, but the loss is just really more of a paper loss and not an actual, right? When you're in that decrease, though, those losses, when you take the money out of there, it no longer has the ability to go back up, right? The rest of the stuff does, but you took that out at a down market, and now then it locked that in. So it turned a paper loss into an actual loss. Well, and you can't regain from that.
Let's draw that out, because that visual always helps me. And so if you have essentially a market asset, right, that's going like this and kind of up and down, then what happens is in these down years, if you're taking withdrawals off of this, right, you're taking a withdrawal here, and then your increase is a little bit less. Then you take a withdrawal here, your increase is a little bit less. Then look at this big one right here. You go all the way down to here. Now the idea with averages is if you do have a down year, you can catch back up.
Right.
But if you made a withdrawal in that year, it's going to take multiple times, right, whatever the gain was that rebounded to make that portfolio balance up. And that's what really messes people up, right, is that they're too aggressive with their withdrawal strategy. These down years, which in the last 25 years they didn't happen that often, but when it did, they were pretty big drawdowns.
Yeah.
And so those drawdowns caused, especially for those that were in retirement, to take withdrawals. And so when the market did rebound, their portfolio balance didn't rebound.
Yeah, and there's another piece here too. When you look at this is what people really need to be educated on, is when we have the up years, those are ups that are going to balance a down, or to put it another way, they're going to rebound from a previous down. And a lot of times people will look at that and say, well, this is more than we expected to have in the portfolio, so we can go ahead and pull extra money. But if you do that, now then there's nothing to fix it on the next down.
So it's kind of like if they're pulling 4% here, 4% here, but then here it's like, whoa, we crushed it. The market did 30%. So let's take, 8%. But then it draws down, and now, like I said, it wipes people out in a lot of situations, because there's taxes that are required with all this. There's still fees that are being taken out. So we're not saying that this isn't solvable, right? We're just saying that the typical financial world, this is how they approach it. It's what they're trained to do. It's what we're trained to do. We have the licenses. And so we get this education as far as, okay, this scenario, like if you don't present, like you don't get some certifications if you don't present the way they want you to present. It's wild. And you may be thinking, well, why don't we just invest in the S&P 500? And we hear that a lot. But when you're in a mutual fund, or you're in a 401k that has mutual funds, they can't put you into equities 100%.
Right.
They'll get sued. I mean, I think the most is like 10 to 15% in fixed income in bonds, and the rest in equities. But people will get it's fascinating to me as far as where the advice is, and that's where, just as much as the financial services world has evolved over time, the advice has stayed pretty much the same.
Yeah. Well, and when you look at something like this, it's really pretty amazing to see how, we hit $3.5 million here that only lasted 20 years with $146,000 withdrawal.
Yeah, if you bring the slide up again, it's again those you can see that there's some drawdowns in those specific years, like we illustrated on the board.
And
then it smooths out, but look at the impact of those big withdrawals or those
yeah.
big downturns.
So let's go ahead and explain the graph.
Yeah, and I didn't explain the graph well, so if we can bring that back up, because it'll be on all of them. So the scale on the left where it says cash flows, that's for what we have across the bottom. So that's what we're pulling out each year. It started with $146,000 and it's growing over that time frame until we run out. We can see at 89 we didn't actually have enough to cover that whole year. Yep. On the right hand side is the end of year account value, and so that's the scale for the line drawing there, which is the account value or the asset value. And so we can see where it's going down. So it starts up there at that $3.5 million range and bounces around until basically we run out. Yep.
And this option A was the first scenario that you had typed the summary of, where the money ran out at 89.
And this was the suggestion from the typical advisors, right? Yep. Get rid of that life insurance, pay the taxes on it, and let's just add that to the portfolio.
Yep. And the idea is the self-insurance, especially if you have a death benefit that's the same amount as your portfolio. It's like, well, my portfolio is self-insuring me, right? Yeah. And that's the deception sometimes, is you have these surface level claims that may make sense and may have had merit at the time. But in this scenario, that's not an accurate statement.
I don't want to self-insure my car. How about you?
Depends on what kind of car you have, I guess. Well, you have a nice car. So.
Well, but the liability alone, right?
Yeah, that's true. No, that's true. Very true. Okay, let's go to, now we're going to take our approach, right? Because the standard approach is common with big cases. It's common with it. Now, there's things that happen outside of it with financial planning. We're talking more of just the kind of the financial basis, the financial advice side of things. And so as we look at the optimized approach, when we look at optimization is taking into consideration all the resources available, right? Mm-hmm. So even though we're going to present some scenarios based on these facts, there's a lot of other things that we're trained to take into consideration. And that's what we bring, with our wealth strategy sessions that we do for clients. So the first thing is, we're not going to cancel life insurance. We're going to do a premium offset. Do you want to explain what a premium offset means?
Sure. Go ahead.
Well, it's really the ability to stop paying the premiums, yet the cash flow still continues of that premium being paid from the cash value that is there. And so it's a recycling of money. And what that enables the cash value to do is to continue to rise. Not as fast as when you paid premiums, but still ongoing, yet nothing's coming out of your pocket. Mm-hmm. And really, this is what this person is seeking.
That's what they said.
Yeah,
that's what they said in their claim.
They want to stop paying the
monthly premium
from their pocket.
Yep. All right, and there's other ways to handle your life insurance depending on the certain situation. We won't get into those, but this is the one that made the most sense for this particular case. So now allocate portfolio assets for highest income, right? So before it was, we're trying to take that 4% and let it last until mortality, life expectancy. Now we're looking at, okay, where can we get the highest income, right? That's going to be our initiative and our approach, and we'll explain why in a second. So there's two foundational options that we recommend. The first option is called a volatility buffer. There's another term for it called the cash flow bridge, pretty much the same thing. In those live streams that we did last year, one of the articles that Todd wrote is available in that workbook. So let's go into essentially the last part, which is using the life insurance, elevating the life insurance, right? Because it essentially has proven to be an uncorrelated asset dating back to previous to the first fund in 1920.
Truly uncorrelated, yeah. Right?
Yep. Okay, so let's look at some numbers. So volatility buffer, annual income, we're going to do the same one, 146,400. End of the 25th year, 297,601. So this portfolio runs out of money at year 19.
Wow. So less than the other one, right?
So it's a $2.5
instead
million
of going
portfolio,
20, right?
$2.5 million portfolio. So it runs out at 19.
But that's pretty amazing that it had $1,000,001 less in the portfolio, and yet it ran for only a year less than the other portfolio.
So let's draw that one out, because that's sometimes kind of hard to understand. So we're going to use the same graph. So if you have that volatility, it's not going to have to be the same, obviously. So let's talk about, again, volatility buffer. So now, before you just had one pool of capital, which was the portfolio.
That's
now
it.
you have two, right? So the first one is a portfolio. Second one is the cash value. Okay, so how does the volatility buffer work?
Yeah, well, so the difference is what you were talking about before is these down years and having to pull money, right? And how you can't catch up, right? What if we could just clip those off? What if in those years, rather than taking money, we went to the other portfolio so that those losses now stayed as just paper losses and weren't actualized losses? And so basically we have allowed, when it went down, for those dollars to have an opportunity to regain because we're only pulling off when the market is positive.
So the rule is, when there is a down year, the year after, you pull from the life insurance and you allow the portfolio to come back up, and you just continue to do that. And I think in this scenario it was done like 7 or 8 times.
Right.
Yeah.
And it's amazing that it's just that few times, right? There were only 7 or 8 losses in that time frame that caused that dramatic decrease in the portfolio without having the buffer in there.
So again, it's like, when I'll just draw just to make sure you guys get this, right? So when there's this down year, in this year, okay, you would withdraw before. That's Monte Carlo, right? But instead, you take a withdrawal from cash value, so the portfolio balance stays there, right? So now it's allowed to rebound, and it goes up, then it goes down. So in this year, right, same exact thing. Now you pull from cash value for income, portfolio balance stays the same. It doesn't get drawn down again. Okay. All right, so again, they run out of money at year 19, but
they don't.
But they don't, right? So keeping the life insurance, even with the premium offset, there's $2.3 million. So it includes all the withdrawals that they took. Right. Obviously, there's dividends, there's guaranteed interest. They're not making any contributions out of pocket, but they have $2.3 million at that 19 years.
Which is pretty amazing, because it went from $1,000,001 or something, or no, $1,000,005, right? We didn't have to take it out, liquidate it, and pay the tax on it. Instead, we just took out what was needed in those down years. And even though we weren't paying premiums, the cash value, even with those withdrawals, still rose by another $700,000, right?
So death benefit, $3.18 million, and then the cash value withdrawals were where they got income from year 19 when they ran out of money in their portfolio and on. And so taking all that income out, right? So it's both the portfolio withdrawals, it's the withdrawals from life insurance. They pulled $5.3 million of income.
Right.
Because they withdrew it every single year until 25.
Right. And so think about the difference there. The first portfolio, they literally ran out of everything except for their house in 20 years. Here in 19, we ran out of cash from the portfolio, but we still had cash value that carried the whole 25 years and still had money left over.
So just to tie in the names, so volatility buffer implies that while your stock market account is going up and down, you have another account that is solid that you can turn to buffer that volatility. That's why that language is there. And the same is true of the cash flow bridge. So you have an account that's going up and down, and you have this other account, and they can bridge between them in the down years so that your income doesn't get affected, even though your account's going up and down. A third way to think of it, if this is helpful, is your cash value of whole life insurance is like a relief pitcher that comes into the game in baseball. Well, the main pitcher knows that he can throw all out for as long as he is able to, because he knows of the relief pitcher that's going to come in and be there for him. Because he doesn't know how good his arm is. We don't know what the stock market's going to do, yet we know it's going to go up and down. So having that there for you, that's what that cash value can do with much more certainty than a bond account, which is what has typically been used in the past for that strategy.
And that's a key point, right? Because modern portfolio theory existed because of that dynamic, but because bonds and equities are no longer, I mean, they're hardly uncorrelated, right? That it just doesn't work that way anymore. But with life insurance, if you look at all the guarantees, you look at dividends, because I mean, life insurance companies are heavily invested in bonds, but that's not the only thing they invest in. Plus, there's mortality gains, the law of large number gains, and ultimately they have the guarantees.
And longevity.
See, that's
of
the
their
thing.
investment.
What happens with the individual? They surrender a bond short of it finishing out, and now then they're not getting the full value of the bond. Life insurance company, they have all the time in the world. They don't have to surrender short, so they get the full value of the bond.
But this talks about the education around trading and investing, right? Because I was with the CEO of one of the companies that we work with, and the stories he tells around what happened a couple of years ago when interest rates, spiked. And now, so when interest rates go up, the value of a bond goes down, right? So it has a inverse relationship. And so they actually sold at a loss in order to buy. They sold some of their portfolio at a loss in order to buy at some really good deals, because they understood that they would make up that loss because bonds have that guaranteed interest associated with it. So anyway. So that's another benefit I would say with especially insurance companies, whole life, that have dividends, mutual companies, because it's kind of like you have an institutional investment partner. All right, so let's talk about this. Let's talk about this graph. So this is graphing essentially the volatility buffer. So in the first graph, you saw that there was some pretty significant volatility. There's still a little bit of volatility.
Oh yeah, because we're still in the market, right?
Yeah.
But the other one was the whole thing. The green line crashed in 20 years, and there was no more income either. This one,
smoothed it all
we
out.
can see that we made it all the way. Now we're down to, what is that? Probably around $1 million of cash, but we also were able to get full after inflation income the entire 25 years.
Okay, so that's one strategy. And when you look at what, you're probably asking, well, what strategy is better? And that's where it comes to optimization. What Kim was talking about is we don't go one or the other, right? Depending on circumstances plus some other circumstances, it's typically a combination of both. So covered asset, basically what it means is that you have an equivalent death benefit to an asset that you will accelerate the spending of, right? So again, our objective is not to let money last, it's to try to get the highest amount of income with the least amount of risk. So we're still, our target's still the same, right? We're trying to, obviously use apples to apples comparison. So covered asset, starting income is different. So why is it different?
Well, because that's actually the annuity income. So
let's
it's
explain
not
that.
what we're going to pull off. It's what we're going to use because, so let me see if I can explain this. All right. So if we took the whole portfolio, the $2.5 million, and we traded in for an annuity, we're going to lose the value of those dollars.
We got to explain that. So let's explain an annuity. And there's a million different types of annuities, but this is the original annuity, which is essentially a lump sum of money you give to an insurance company. And it's kind of like the opposite of life insurance. Right. So they promise a specific guaranteed contractual payment every year until you die. It could be 5 years. It could be 150 years. They know those numbers. They know all the actuarial math. Okay. So this is essentially trading that $2.5 billion, right, for an annuity and a stream of payments, which ends up being $197,000 a year.
Right. Which is hard for a lot of people to do, right? Because it's like, well, what if I die early? That means I didn't get the full benefit of my whole $2.5 million. It just disappears and goes somewhere else, right? And that is the power of the covered asset. If we have life insurance in place, now then it frees us up to do that and to optimize that cash flow, knowing that death benefit is going to come back in and replace that asset on our death. Right?
So the annuity, it's a flat amount, and it goes, obviously in this case, it's going to go for 25 years. That's kind of what we projected.
Well, but
if they live longer,
it
keeps on going. And that's such a critical point. That peace of mind that no matter how long you live, well past whatever asset you had, that insurance company that has been around for probably close to a couple centuries is going to pay that monthly income.
So what we had to do is, because there's cost of living that happens. So you have to account for that, because in the beginning, there's excess of like $50,000. But as you go out and that compounding takes effect, okay, you're not going to have enough if you're just taking 197. So what do you do?
That's exactly right. And so what we did was we took the $197,000 from the annuity, but we only spent $146,000. The same amount of money we were spending in the other scenarios, and we took that differential and put it in the portfolio and let it grow so that it, at some point in time, will take over the fact that the $197,000 is not going to be enough money to cover the 3% inflation.
Yep.
Right?
We could have simulated cash. That would have been interesting. We didn't do that, but
Right.
we put it back in the portfolio.
And I just want to address for a minute the 3% inflation, because I think a lot of people look at, well, my 70s, my 80s, yeah, I'm going to continue to travel more, increase various things, but this is not increasing income. This is just keeping pace with inflation. And while in your 90s, you might be looking at this continued increasing income and thinking, well, I'm not really going to need that because maybe I'll stop traveling or what have you. It's amazing to me to watch 80 and 90-year-olds that we all know and the increase in services that are required for them to live their lives. Maybe it's now the house has got to get cleaned every week instead of every other. Maybe it's they need a driver because they're no longer able to drive themselves. Maybe it's they need, fill in the blank, food handled for them in a way that they did not used to have to pay in the past. They need lawn care that they used to be willing to do themselves. Now they aren't. So there's a lot of things going on there. And, this is a bit of guesswork, but it's guesswork based on what we see, and not only our families, but our clients as they go through those various phases in life.
So we're going to get to the fact that, well, let's just go through to the end. So 25th year, same amount of income. They never run out of money. The total income over that 25 years is the same as it was before, 5.337. But now you look at the cash value, 4.7 million, and the legacy is 5.1 million. Okay?
Amazing.
Yep. So
And
here,
the graph?
So here, let's do the graph, and then we got some bad news. But I'll leave that for a second. Go ahead.
We have some bad news.
We have some bad news. Yeah.
Oh, okay. So what we see here is, again, the same amount of money being spent, the 146,000 growing out to 297 over that time frame, the full 25 years. But what's happened is, because the life insurance was left alone during the whole time frame, because the insurance company was going to guarantee that annuity payment. Once we took the $2.5 million portfolio, exchanged it for an annuity, they guaranteed that payout of $197,000 the whole way. Our cash value was uninterrupted on its growth across that whole time frame. So it was able to be left alone. So that $1.5 million number where it started is now up in the beyond 4.3 million, whatever that is, right?
Okay, so let's put them all together, right? So this shows all three scenarios, right? So the ones, the optimized strategies in green line and blue line, and obviously the typical approach by financial planning is the yellow line. So the reason why I said there's
the bad news
with the annuities
right.
is we actually can't do that. Like we could get sued, we could lose licenses, right? Because you create such illiquidity, even though they have the life insurance. Right, you typically cannot advise someone that takes their entire portfolio and puts that into annuity.
You'd have to leave 10 or 20%.
Which to me, obviously, you look at the end result and it's like there's justifiable evidence, but a lot of the compliance industry is built around more of the typical financial planning, right?
Yeah.
So when things like these can make sense, sometimes we're just not able to. So not say that you can't do everything, but typically what we'll do is we'll look at, okay, what does the portfolio look like? You look at some volatility buffer, some covered asset. Obviously, we're factoring in everything without Social Security, so that's another. There could be other assets, rental properties. We just wanted to try to make it simple, just this simple, typical financial planning approach, and then two optimized strategies.
Yeah, I think though bad news that you were talking about. If we look at the chart again. Part of the bad news, and this is where people have a problem with the annuity, is, and especially if you don't have a covered asset, it really makes it hard.
It does.
But what we see that blue line there where it starts, it's well below the orange line and the green line, right? It starts out. Why? Because we gave up that $2.5 million. If death were to occur in that, at age 71, we only got $197,000, and we traded it for $2.5 million. Okay, so that's where the drop is. But what's kind of amazing is when you start to look at that, look how quickly it catches it. In 6 years, it's got a crossover point with where the other portfolio would be. So it's only 6 years out, and all of a sudden we've got as much as there, and then of course it just continues to climb. So,
Hey, thanks so much for watching. Hope you guys enjoyed the content. Make sure you like the video. Also subscribe to the YouTube channel. And also don't forget that in the description is a link to the Perpetual Wealth Academy, where we have a ton of free resources for you so that you can continue your financial education. If you have questions, don't forget to make a comment, ask those questions, and we'll make sure we'll get back to you. All right, we'll see you on the next video.